Mastering your taxes starts with one specific metric, adjusted gross income, or AGI. This baseline number determines your tax obligations for the entire year. By the end of this tutorial, you will have calculated your personal AGI and identified exactly where it belongs on your tax return. First, you need to gather your primary income documents. Pause the video and collect your W-2s from your employer and any 1099 forms for freelance or contract work. You also need your secondary records. This includes receipts for student loan interest, your health savings account contribution records, and your traditional IRA statements. Keep a calculator nearby as well. Having these specific documents ready prevents mathematical errors and ensures you claim every deduction the government legally allows you to take at this stage. We begin with gross income. This is the absolute total of all money you earned and received throughout the entire calendar year. For most taxpayers, the foundation of this total is the standard W-2 wages reported by an employer. Take your base W-2 salary and add any independent contractor income from 1099 NEC forms. Next, include investment-based income, like dividends and capital gains realized during the year. Finally, add any retirement distributions. Combined, this gives your final gross income tally. Reporting every stream of income is essential. Leaving out side hustle earnings or investment yields is a frequent trigger for IRS audits and financial penalties. Now we apply above-the-line deductions. These are specific, highly restricted expenses that the IRS allows you to subtract directly from your gross income. Looking at the checklist, the most common adjustments are traditional IRA contributions and student loan interest. You cannot legally deduct Roth IRA contributions here. Other niche deductions include HSA contributions and educator expenses. These adjustments add up to $4,000. Do not subtract your standard deduction yet. That is a separate step that happens later in the tax filing process. Similarly, do not subtract any itemized deductions, like charitable gifts or mortgage interest at this stage. Isolating these specific above-the-line adjustments is the legal method for shrinking your taxable footprint before any other deductions are applied. Now execute the core math. As shown in this formula, subtract your total adjustments from your total gross income. This final result is your official adjusted gross income. Now that the calculation is done, let's find exactly where this number goes on your actual tax paperwork. On the first page of your IRS Form 1040, write your final AGI on the line clearly labeled Adjusted Gross Income, highlighted here in yellow. Securing this figure is the bridge between gathering raw financial data and completing a successful optimized tax filing. With the calculation complete, the government uses this AGI to determine your overarching tax bracket for the year. A strategically lowered AGI qualifies you for specific tax credits that higher earners are ineligible to receive. Lowering this number directly protects your income. Much like a dam diverting a river into a safe reservoir, a calculated AGI ensures more of your money stays under your control, allowing you to reach your savings goals faster. Now, take this number and input it into your tax software, or provide it directly to your CPA. Mastering metrics like your AGI is the first step toward taking full control of your annual tax planning. Subscribe for tactical financial guides. Always consult a tax professional and safely file your return.